A billion-dollar crypto haul for one high-profile investor is putting the spotlight on the painful reality for millions of others who are still sitting on massive losses, and it's a stark reminder that the crypto market can be a wild ride. Former President Donald Trump's recent foray into cryptocurrency has reportedly yielded a whopping billion-dollar profit, but for many everyday investors, the story is very different. The ongoing bear market has erased trillions of dollars in paper profits, leaving countless individuals wondering when, or if, they'll ever see a return on their investment. This matters because it highlights the inherent volatility of the crypto space and the need for investors to approach it with caution, doing their due diligence and not getting caught up in the hype. The crypto market's unpredictability is a stark contrast to the relative calm in the traditional stock market, where investors have been taking a more optimistic view, at least for now. As the US observed its Independence Day holiday, stocks actually climbed, and the dollar fell, as concerns about the impact of AI on trade began to subside. This upward trend is significant because it suggests that investors are still confident in the overall health of the economy, despite some ongoing jitters about the role of artificial intelligence in the marketplace. With Europe's benchmark holding near a record high, it's clear that investors are looking beyond the current uncertainty and betting on a stronger future. As we look at the performance of various investment strategies, one standout is Citadel's hedge funds, which have posted broad gains in the first half of the year. Their tactical trading fund, in particular, has been a top performer, sidestepping the quant selloff with an impressive 14.3% climb through the end of June. This matters because it shows that even in a challenging market environment, there are still opportunities for savvy investors to generate returns. By combining discretionary equity investing with quantitative strategies, Citadel's approach has proven to be a winning formula, and it's likely that other investors will be taking notice. But despite these positive signs, there are still concerns about the overall appetite for U.S. stocks. According to Bank of America, investors are turning away from U.S. stocks at the fastest pace since March, with outflows reaching their largest in over 3 months. This is a significant shift, as it suggests that some investors are becoming increasingly cautious about the U.S. market, potentially due to concerns about valuations or the broader economic outlook. As we move forward, it will be important to watch how this trend develops and whether it has a lasting impact on the market. In other news, Taiwanese brokerage Uinta is tapping banks for a massive $1.3 billion in loans, highlighting surging demand for financial services amid the stock boom. This move is notable because it underscores the growing importance of the Asian market, where investors are increasingly looking for opportunities to participate in the global economy. With Uinta seeking to expand its operations and meet the rising demand for financial services, it's clear that this trend is only going to continue, and investors would do well to pay attention to the opportunities emerging in this region. As we wrap up this week's coverage, the big question on everyone's mind is what the second half of the year holds for investors, and will the current trends continue to shape the market landscape?